Conventional mortgage loans, they're not insured or guaranteed by a government agency. The lender assumes the risk of default. Mortgage insurance is required for loans with less than 20% down. Non-conventional loans, they provide some risk protection to the lender, therefore they require a smaller down payment. FHA loans are insured and VA loans are guaranteed. Some of the conventional mortgage loan features includes the interest rate negotiated between the lender and the borrower. It has a due on sale clause, which prevents assumption, it's not assumable. And there's a lower loan to value ratio than FHA and VA loans. Conventional mortgage loans usually require a larger down payment. 20% down payment, which equals an 80% loan to value ratio, will avoid the private mortgage insurance. If a borrower does not put the 20% down, they have to pay the private mortgage insurance, which usually insures the part of the loan above 80%. Again, interest rates are based on market conditions and negotiated between the lender and the borrower. Qualifying for a conventional mortgage loan, they take your gross monthly income. They use it to calculate the qualifying ratio for borrowers, and they use a total obligations ratio, and it cannot exceed 36%. And the way they calculate that is they take the total monthly obligations and divide it by the monthly gross income. Here's your first math that goes with it. Mick's total monthly obligations are $2,350, and his monthly income is $5,250. What is his total obligations ratio? Again, we're looking for something less than 100%, correct? So you're going to take the little and divide it by the big. 2,350 divided by 5,250, 45% total monthly obligations ratio means he's not going to qualify. Fixed amortized mortgages, they have regular periodic payments for a fixed constant amount. And at the end of the loan term, all the principal and interest is paid in full. The payment for principal and interest is the same each month. However, in the beginning, more of that payment is applied to interest and less is applied to principal. As each payment is made, then less goes to the interest and more in the month goes to the principal. Information needed to amortize a mortgage: you need the outstanding debt, the principal amount owed, the interest rate, and the monthly payment. Here's your formula. You take the principal balance and multiply it times the annual interest rate. You take that figure and divide it by 12, and that will give you the first month's interest. Then you take the monthly mortgage payment and subtract that amount of interest that is applied. What that leaves you is the amount that's going to be applied towards the principal. To get the second month's principal and interest figured out, you're going to take the little bit that was applied to the principal and subtract it from the principal balance you started out with. Now you'll have a new principal balance. You're going to do the same thing all over again. Multiply it times the interest rate. Divide that by 12. Now you have the second month's interest portion. You subtract that from the payment and you have now the second month's principal portion. And a math problem for you. Danny's home has $65,000 mortgage at a 3 3/4% interest rate. Danny's monthly principal and interest payment is $357.25. What is the amount paid to the principal in the second month? Again, this is when you're going to want to pause and try to work the problem out before revealing the answer. And here it is. A lot of work, but it's easy, so don't let it frustrate you. $65,000 times 3 3/4. That gives you the yearly interest rate. Remember, we're going to divide that by 12 to get that first month's interest, which is $203.13. Subtract that from the monthly payment, and it tells you that $154.12 was applied to that first month's principal. You're done with the first month. Now you got to figure out the second month. So you start all over again, but before you can do that, you've got to subtract the portion that was applied to the principal from the original balance of $65,000. So now you have a new principal balance, which is that $64,000 figure. Now you can start all over again. The $64,000 figure times 3 3/4, you get your yearly interest, $2431.72 divided by 12. Your second month's amount that is applied to the interest is $202.64. Once taken away from the payment, leaves you $154.61. That is the amount of principal applied to the second month. Adjustable rate mortgages. The interest rate can change. The index is an indicator of the cost for the lender to borrow the funds and is not controlled by the lender. Now the margin, or sometimes called the spread, and they can use these words interchangeably, so it can be either word, margin or spread, is usually a fixed percentage that's determined by the lender. And the way they figure up the calculated interest rate is index plus margin. Had a student tell me in one of the classes, the way she remembered it is I'm interesting. I for index, M for margin, and interesting represented calculated interest rate. Partially amortized mortgage, also known as a balloon mortgage, the payments are not large enough to pay off the loan by the end of the term. The balloon payment's the final payment of unpaid principal and accrued interest. Biweekly mortgage. Payments are made every 2 weeks, and each payment is 1/2 of the regular monthly payment. It equates to 13 monthly payments a year and reduces the amount of payments by like 7 years in most cases. Package mortgage. That includes both real and personal property as collateral. Like you see in the slide, a restaurant would be a great example. If you buy the bricks, mortar, and land, that's your real property. If you also purchase the stoves, the booths, the ovens, the make tables, and all the other stuff, that's the personal property or the fixtures of the trade. So that would include both real and personal property as collateral. Homeowners use home equity loans to finance consumer purchases. Consolidate existing credit card debt and pay for college tuition, medical expenses, or home improvements. Because the interest on most home equity loans is tax deductible, they're more popular than other types of consumer credit. Purchase money mortgage. If you see that term, they're talking about seller financing, and that's referred to as a vendor's lien. The vendor is the seller, the vendee is the buyer. Reverse mortgage. They're available through FHA approved lenders for homeowners 62 or older that want to cash out the equity in their home. FHA, Federal Housing Administration, is a government agency within HUD. It functions as an insurance company, insures mortgage loans made by approved lenders. Lenders set the interest rates and they may charge points. Section 203B is a fixed rate mortgage loan. Some of the characteristics of an FHA mortgage: loans are made by FHA approved lenders. FHA does not loan money. They insure loans. Lenders may charge discount points And the minimum cash investment, the actual down payment, is 3.5%. So if someone purchases a home and the sales price is $100,000, they have to put 3.5% down, which is $3,500, and pay their closing cost. FHA does set limits on the amount that can be borrowed, depending on the average cost of housing in the various regions of the country. So if you get a question asking you, what is or does FHA have loan limits? The answer is yes, but it depends on where the property is located. Other characteristics of an FHA mortgage loan: insurance premiums are required if less than 20% is put down. At closing, an upfront mortgage insurance premium is required, as well as the annual premium is going to be paid in monthly installments, which is added to the monthly housing payment. Okay, it's also added to the housing expense for calculating qualifying ratios. So not putting 20% down could make or break whether somebody qualifies for an FHA loan or not. Okay, qualifying ratios for FHA, they have a housing expense ratio. That is the monthly housing expenses. They consider it principal, interest, taxes, insurance, and mortgage insurance premium. They take all that up, add it together, and divide it by the gross income. And the housing expense ratio cannot exceed 31% for FHA loans. FHA also has a qualifying total obligations ratio. It's determined the same way, and it cannot exceed 43%. FHA mortgage loans are fully assumable. The interest rate is negotiated between lender and borrower. Appraisals are required. And if a new developer is building, they have to have an FHA commitment to ensure loans are available for the new buildings. VA Loan Guarantee Program. That's a partial guarantee to the lender in event of default. Veterans, unremarried surviving spouses of veterans, and active military may apply. Specific eligibility is based on the period of active duty or period of continuous service. VA loans are made by VA-approved lenders. Now remember, I told you FHA cannot loan money. They don't loan money. They just insure loans. VA can actually make direct loans if needed to the vet. Qualifying ratios for VA. There's no housing expense ratio, and they do have a table of residual income. They want to make sure that the veteran has enough residual income each month. And the maximum total obligations ratio for VA is 41%. VA loan guarantee and entitlement in 2015, the maximum entitlement, the guarantee, was 104,250. The entitlement is the maximum amount that the government guarantees the lender in event that the borrower defaults. It's based on a certificate of eligibility, which the amount that the veteran gets is based on his years of service. Was there a war? Did he serve overseas? All that's like factored in. There is reusing entitlements. Lenders can charge a loan origination fee, and instead of mortgage insurance premium, they charge a VA funding fee to help defray the cost of foreclosures. Some other characteristics: no maximum loan limit, VA funding fees, and no mortgage insurance premiums. The closing costs. Some closing costs can't be paid by the veteran even if they elect to. VA loans are fully assumable even by non-veterans, and interest rates are based on the market and negotiated between the borrower and the lender. There's no down payment required, and payments include taxes and insurance premiums held in escrow. The maximum loan term limit is 30 years, and there's no prepayment penalty. To qualify for a loan, a lender is going to check information on the borrower's employment, credit history, assets, among other things. They run credit reports, get a credit evaluation and credit scoring. They have qualifying ratios, qualifying the property, which is the appraisal to make sure that it appraises for what the veteran wants to pay, and then pre-approval and pre-qualification. Primary mortgage market. That's made up of primary lenders that originate new mortgage loans, such as savings associations, commercial banks, credit union, and mortgage lenders. Intermediation is thrift institutions. They're financial intermediaries. They are banks, savings associations, and credit unions. Intermediation is by consolidating individual savings accounts of depositors in those banks, savings associations, and credit unions and investing them in loans. That's intermediation. Savings associations are chartered by the state or federal government. Federally chartered savings associations either have federal or FA in their name. They prefer to make conventional mortgage loans, but they'll also make FHA and VA loans. Commercial banks. They hold demand deposits, checking accounts. They're chartered by the state or federal government, and they're national banks. They're members of the Federal Reserve System, and they have national or NA in their name. They make conventional FHA and VA mortgage loans, and their accounts are insured by FDIC. Credit unions are nonprofit cooperative organizations. They're chartered by the state or federal government. Known as National Credit Union Association, they provide financing for residential and home improvement loans, and credit unions can make 30-year real estate and FHA and VA loans. Now, we have mortgage lenders, mortgage brokers, and mortgage loan originators. Need to know the difference between them. A mortgage lender is the only one who makes and services mortgage loans. They're the ones who lend the dollars. They are a mortgage company, and they sell those mortgages to non-institutional investors. It's not a depository institution, meaning you can't go open a checking account there. Mortgage broker don't lend money. They conduct loan originator duties, and they employ loan originators. They don't make loans. They don't service loans. They work with lenders to arrange loans for borrowers. And mortgage loan originators. Again, they do not lend money. They are the middleman, the agent between the borrower and the lender. They work with borrowers and lenders to arrange a loan. They process mortgage loan applications, but they do not make or service loans. Safe Mortgage Licensing Act set minimum standards for licensing of mortgage loan originators. Employees of banks, savings associations, credit unions that are regulated by the Federal Banking Agency have to register with the National Mortgage Licensing System. If they're not employed by a federal agency, regulated institution, they must also be licensed by the state. Your secondary mortgage market. That's an investor market that buys and sells existing securities. It circulates mortgage money supply and standardizes loan requirements. Fannie Mae. That is the Federal National Mortgage Association. They are a government-sponsored enterprise. They're under federal government conservatorship. The Federal Housing Finance Agency has supervisory responsibility. They purchase FHA, VA, and conventional loans meeting its criteria. Those are referred to as conforming loans. And they issue mortgage-backed securities which are sold to investors. Freddie Mac. That's the Federal Home Loan Mortgage Corporation. They too are a government-sponsored entity. They're under federal government conservatorship, and the Federal Housing Financing Agency has regulatory oversight. They purchase loans from savings associations, and they're primarily conventional loans. Then you have Ginnie Mae. That's your Government National Mortgage Association. They are the only true government-owned corporation. The government agency is part of HUD, who guarantees securities backed by pools of mortgages. Ginnie Mae does not buy mortgages or issue mortgage-backed securities. What they do is act as a guarantor to investors of certain mortgage-backed securities. And the little ditty that you can remember about Ginnie Mae is GGGGG, all G's, government, guaranteed, Ginnie Mae. Common types of mortgage fraud is using a straw buyer or no documentation loans. Some red flags would include inflated appraisals or incorrect purchase price. Mortgage fraud is a third-degree felony in Florida. Your Equal Credit Opportunity Act makes credit available without discrimination based on race, color, religion, national origin, sex, marital status, age, and receipt of public assistance. So if a 100-year-old man goes into the bank and wants to get a 30-year loan and the collateral's there, the credit's there, everything's there, just like it would be for you or me, the bank cannot turn him down because of his age. Truth in Lending Act is concerned with the true cost of credit and bait and switch advertising. Federal Regulation Z is part of it. It's to inform consumers of exact credit cost. It applies to consumer credit, residential mortgage loans, but it does not regulate interest rates. Some required disclosures of credit costs would be to disclose the finance charge, total amount financed, total amount of payments, and the annual percentage rate within 1/8 of 1%. And remember, it makes bait and switch advertising illegal. Triggering terms. What's a triggering term? A triggering term is a term in an advertisement that causes the advertiser to also disclose other things, such as the amount or percentage of the down payment, terms of repayment, or annual percentage rate. A triggering term is a term, it's a money, it is a number, an absolute number. So if you see an advertisement that says 0 down, great deal, blah, 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 0 is an absolute number. If you have that in there, then the person has to also disclose the amount and percentage of down payment, terms of repayment, and annual percentage rate. Anything with a number. You hear an advertisement that says, great deals on cars this month. Pay anywhere from $50 to $200 for 2 years only. You've got lots of numbers in there. It's going to cause the additional disclosures. What is not a triggering term? Here's an example, a couple of them. Low down payment. You can't calculate low down payment. It's not a number. You also can't calculate easy financing. So those are some non-triggering terms. Let's talk about the 3 business day right of rescission. The borrower has a right to cancel a loan. The borrower can waive the right of rescission. However, it does not apply to loans to purchase or construct a home. But it does apply to home equity lines of credit, second mortgages, and refinance loans. Real Estate Settlement Procedures Act, RESPA. That's mostly concerned with the cost associated with closings. It's a consumer protection law. It requires the disclosure of the amount and type of charges due at closing. It attempts to eliminate kickbacks and referral fees. and it applies to federally related residential loans, loans which are secured with mortgages on one-family to four-family residential units. Other RESPA requirements include affiliated business relationship disclosures, purchase of title insurance. The buyer or seller can't be told where they have to close title. It's their choice. It limits the escrow for taxes and insurance. And again, it tries to eliminate kickbacks, fee splitting, and unearned fees.